So we'll start. And once again, good morning, everyone. Thank you so much for joining on this Saturday morning. Good to see at least 100 participants in initial phase. Welcome to this 15th session of Niveshakon Se Samwaad. And as you guys are aware that Niveshakon Se Samwaad, this is a platform which is meant for the value addition. So everyone talks about the equity market. So equity markets are at the all-time high. And the common question which, whenever we guys meet you, common question that should we follow the asset allocation? Does it make any sense to invest in a debt products at this moment of time? Whether RBI is going to follow the Fed's path? What should one take, advantage of this high interest rates? Is it peak of the interest rates, or how do you see this? What's our view on the economy and the market? And to answer all these questions today, we have none other than Mr. Kaustubh Gupta. Mr. Kaustubh Gupta, he's a co-head of the fixed income at Aditya Birla Sun Life AMC Limited. Kaustubh brings with him around 17 years of extensive investment experience, having worked in various capacity of treasury finance, liquidity management, and fund management. As co-head, Kaustubh leads the overall fixed income portfolio management. Prior to joining ABSL AMC in 2009, Kaustubh worked with ICICI Bank for 5 years in the asset liability management team. He's chartered accountant and CFA level 2 by the qualification. So thank you so much, Kaustubh, for joining.
Thank you, Amit, and namaste to everyone.
Thank you. So Kaustubh, I think how we run this program, initially you speak for 25 minutes about your views on the markets, RBI policy, how one should see, and then we will take a Q&A.
Okay.
Okay.
Let me start with first take on the global macro, because at least in these times it seems that the global macro is the basic fabric which is driving the policy makers, whether it's fiscal or monetary. So it's very, very important that although our largely investments are in India, but we need to have a better understanding which way the global things are moving around. And of course, the surprise element came day before yesterday when Fed, of course, came out a lot more dovish than what was supposed to be. First of all, on FOMC meeting, of course, it was expected that Fed will hold rate, and the consensus estimate was that Fed will start cutting rates in 2024, so there is no change to it. But the dovishness comes in terms of communication at which the Fed indicated market that the kind of rate cuts which will start in 2024. And before this meeting, markets were pricing in that there will be 5 rate cuts in 2024. What Fed indicated in their FOMC statement was that there will be 3 cuts. So at margin, you can say the Fed is relatively less hawkish than less dovish than markets if you see what they are writing on paper. But when it's come to the communication part of it, that's where the dovishness part of the market got enforced, that probably Fed is ready to move from 3 rate cuts to probably 5 rate cuts. Now, what did Fed said? What Fed said is that they don't want to over tight conditions or overkill growth, and for that they are okay that even if inflation doesn't get back to 2%, they will start cutting rates if the momentum is 2%, which means that earlier market was pricing is that first inflation will fall to 2%, or rather Fed make market to believe that first inflation will fall to 2% and that Fed will start cutting rates. But now Fed is saying that they will start cutting rates prior to 2%, which means that markets which were of the view that May is a policy, they will start cutting rates. Now market are saying in March only they will start cutting rates. Second thing, Fed didn't have any pushback to market pricing of 5 rate cuts when Fed is indicating they are doing 3 rate cuts. If you remember in the prior policy which happened in October, when the similar question was asked that markets are pricing deeper rate cut and Fed is indicating lesser rate cut, in that meeting Powell indicated that it is up to the market, but in our view we think that there are maximum 3 rate cuts. This time when the similar question was asked, Fed said, or Powell said, it's market job to do things, we'll do what we want to do. In a sense that Fed didn't push back that 5 rate cut is incorrect pricing, which they indicated in the prior FOMC meeting. So that's the second dovishness or the dovish statement that they indicated to the market. Third indication that they broadly try to indicate to the market is that when they try to claim some bit of victory over inflation, when they said that, look, up till now, inflation slowdown has been driven largely by supply side of the measures, and monetary policy work with lag, which means that the demand supply measures is still yet to come, which means that they are a lot more confident now that the inflation will not be as big as a problem for policy making. In fact, Fed went to the extent that in incremental policy meetings, the discussion will be around when to start rate cut and what quantum rate cut should be sufficient. Prior to this policy, they were saying that the discussion is that what is the terminal rate. In fact, as per the last policy meeting, they indicated that they will hike in this policy. So not only they pause, now the communication that Fed is trying to say is that they think the rates have peaked, and the incremental discussion will be what quantum and when to start rate cut. So clearly, as against the market expectation, Fed turned out to be a lot more dovish. Now, what is the reason of this dovishness? It is very important to understand that why this change of heart in FOMC meeting. The first thing is when we look at a high frequency indicators, and if you look at the last 6 months momentum of core PCE, which is what Fed primary target, that is already below 2%. In fact, that as a matter of fact, that number is at 1.9% in last 6 months, and as per our expectation, the next reading, which is going to come in December for November, that 6 month average will fall down further to closer to 1.75, which means that inflation at margin is giving them space to become dovish. But in our understanding, to cut rates, they need clear growth slowdown. Now, Fed has forecasted that next year, US will grow at 1.4%, when in this year they are growing closer to 2.5 to 2.75%, or in fact slightly higher than that. So clearly Fed is looking at the data, and they are getting this comfort that next year economy will slow down big time because of the lag effect of policy making. The third thing is that if you look at the data, generally the China PPI and China CPI, as far as inflation is concerned, they leads US inflation by 3 months, and as a matter of fact, China PPI is in negative zone from last 6 months, and last month China PPI was also in negative zone, which means that the historical data stands true, or historical correlation stands true. Most likely inflation problem is over, and now Fed can switch their policy making bias towards growth. In a way, in all this jumla, what Fed is trying to do is that now they are trying to go for a big trophy, which is trying to make sure, or trying an attempt to make sure, that actually soft landing happens in 2024, which was a kind of apprehension that in history never ever Fed has achieved this soft landing except 1940s. But now, before inflation cooling down, if Fed is making the move to become net margin accommodative, the possibility of soft landing goes up quite incrementally, quite substantially. Now, what is this good news? This good news, what in essence it does is that it brings a lot of good news for risk asset, specifically for bond markets at margin, and to some extent for emerging market as a whole and world growth as a whole. Prior to this meeting, we were of the view that world will grow at closer to 2% in in calendar year 2024. Now we are of the view that world will grow at closer to 2.5 to 275 in 2024, which is at margin a marginal deceleration that what we have seen in 2023. What it does in essence is the most important is for emerging markets. Why? Because as far as emerging market is concerned, they have been running quite conservative, both fiscal and monetary policy compared to developed markets, because there is no space which was available to them. But with this is in the backdrop that for emerging markets, or rather none of the emerging markets, by and large, inflation is a problem. In fact, for most of the emerging markets, they are struggling with lower growth and lower inflation, but they were afraid of easing any monetary policy because US was keeping rates tighter. and they were indicating that rates will remain higher for longer. Now, with this news, at margin, emerging market central bankers, they can shift their gear back to at least neutral zone. I don't know whether they can take it to an acceleration zone right away, but at margin, you will see all emerging market policy makers, they will tone down in their hawkishness and stance, and they will try to sound, at least from communication perspective, similar to what Fed is doing, to be a lot more neutral than what we have seen as of now. The second thing is that at margin, because still US is doing reasonable amount of fiscal, and given that 2024 is the year of politics, when lot of nations will go into some bit of political reassessment, none of the monetary policy makers will like to remain in limelight. So at margin, they will also becomes another reason why they'll become a lot more accommodative than what we have seen up till now. So both the thing together, it seems that at least from a global perspective, rate hikes are over. Policy makers, which has remained a lot more cautious up till now, at margin they will turn neutral to accommodative depending on the local macros, which is local growth, inflation matrices, liquidity, which has been very tight up till now globally. At margin, you will see some bit of respite or even on that term. So from that perspective, it looks fairly easy financial conditions, at least for next 3-4 months, incrementally. Okay, now let's come with this backdrop or with this overall macro picture. Let's see how India is placed. Now, from a macro perspective, clearly India seems to be in a Goldilocks scenario, because what is happening is that because of the slowing demand, the commodity prices, specifically crude, is seeing little bit of headwinds for it, despite so much of geopolitical uncertainty, and especially in last 3 months when even another front in Middle East was open in the form of Israel Hamas. OPEC members extending their overall supply cuts and weakening dollar. Still, commodity prices and crudes, they are softening, which means that the global demand is decelerating faster, and which is kind of good news for India from a commodity perspective. India is that India doesn't want oil to be $20, because that means that the global demand has actually just slipped into kind of a recessionary conditions. For India, the ideal scenario is that crude remains in this range of $65 to $85, and the energy prices is right up there, which means that global demand is resilient, or it is stabilizing, maybe at lower level, and the commodity prices is at margin giving India a lot of headwinds to spend on growth rather than funding our current account deficit. If you look purely from a other perspective, that when I'm saying that this is a kind of a Goldilocks scenario, which means that lower commodity prices is giving a headwind that India inflation, or giving a tailwind that India inflation will remain lower. Our base case is that for FY 24-25, India inflation, average inflation will remain in the range of 4.5 to 4.75, which means that the core inflation will trend between 4 to 4.25, and the food inflation will range closer to 5%, which means that which is where we are coming with the average of 4.5 to 4.75, which means that RBI also can, if it wants or if growth slows at margin, they can also turn at margin a lot more accommodative. On the other hand, the growth engine in India is turning out to be the best in the world, and given the size of the balance sheet that India has, it's a very, very reasonable growth in the backdrop of the things happening on the global macro front. For FY 22-23, our growth estimates are closer to 675, but even for 23-24, we expect growth to remain in the range of 6.25 to 6.5, which is kind of that not too hot, not too cold, which means that there is, at least from a monetary policy perspective, nothing needs to be done to cool India, nothing needs to be done to at least push the growth higher. And at margin, given that the nominal growth is higher, the fiscal, even it will consolidate for next year, still it will have reasonable purse strings to spend and support growth, which is why we do think that India is entering into a Goldilocks scenarios as far as growth inflation dynamic is concerned. Now, in this backdrop, RBI, which has been very proactive up till now and kind of, you can say, very prudent in the sense that they were ahead of Fed in terms of tightening of conditions despite lower growth and not too high inflation. At margin, they can also become accommodative. But when I'm saying accommodative, that doesn't mean that RBI is going to cut rate in haste. Our base case is that because the growth is closer to 6/4 to 6.5, and because the inflation is closer to 4.5 to 5, which is at margin little higher than their target, and given that banking balance sheet and corporate balance sheets, they are much more cleaner, and we hope that political uncertainties in the form of next year general elections has been addressed to some extent, RBI can remain accommodative, but we don't think that RBI will have space for deeper and meaningful rate cuts. We see a very shallower rate cut cycle in India, and most of this rate cut cycle will be back-ended in the sense that even if Fed starts cutting rates at margin, just to ensure that financial stability remains intact and to ensure that inflation at future doesn't become a problem, to ensure that policymakers will have some lever and space if growth slows down, the basic case is that RBI at margin can cut rates maximum by 50 basis points, and most of these rate cuts will happen either in 2024 last quarter or maybe in 2025. So from a fixed income perspective, does it make sense to invest if the rate cuts are not meaningful? So the answer to this question is that, look, in India, most of the yield curves on G-Secs are trading at above 7%, and most of the corporate curves, including bank series, they are trading at closer to 8%. Now, in this scenario, we are a lot more confident that RBI at the inception can become competitive, or they remain accommodative by infusing liquidity rather than doing large rate cuts, which means that these nominal rates, when inflation is at 4.5 to 4.75 and nominal rates at closer to 8% for corporate bonds and for GSEC at closer to 7 to 7.25, they are giving you reasonable real yield. And which is why we do think that these liquidity spreads or the term spreads, which has been factored in because of high US yields, because of tighter liquidity stance, they can correct without even RBI moving on rate front. Most important, next year we will have this bond indices inflows, which means that there will be a compulsive buyer to the tune of $25 billion or 2.5 lakh to 3 lakh crore rupees. Now, government is committed on fiscal FAR, which means that next year, assuming that the government stick to its fiscal deficit part, that the gross supply will remain same. Even the net supply will remain more or less same as it was in FY 23-24. So with a higher nominal balance sheet, the supply will remain same, which means that the demand supply will become massively skewed towards demands, and which is where we do think that the GSEC is the best asset class, at least for next 3 to 6 months. And we expect the 10-year GSEC to gradually move closer to 7 and below. The base case is in between 6.75 and 7. That's where the Indian Gavi yields bottom out. And once this trade plays out, probably the corporate bonds yields, which are trading closer to 8%, they will also settle closer to 7.5% over next 12 months. In a sense, what I'm trying to say is that for the first time, I would say that in post-COVID world, when the rates were taken down closer to 3/4, and then market were struggling that the rates were too low, and then market was struggling in last 18 months when Fed and all central policy bankers, including RBI, were taking rates higher, and there were duration losses. For the first time, it looks like that the days of duration losses are behind us, and at margin, we do see Indian yields across the board, whether it's GSEC or corporate bonds, they will rally to the tune of 25 to 50 basis points. Of course, large part of it is because of liquidity reassessment or because of the term premium reassessment rather than rate cuts. But at least the duration losses are behind us, which is why we do think that investors at margin can actually look to increase duration in their portfolio. To sum up, what I'm trying to say is that at least for 6 months, we do see it makes sense to remain overweight on Gavi bonds, largely central government dated securities, and over 12 to 18 months, we do think that even the 10-year and 5-year and 3-year corporate bonds, they make a lot more sense because most of them are trading in the range of 7.75 to 8%. And we do see that they also settling lower by 25 to 50 basis points. In our active funds, we are massively overweight GSEC as of now, but these are more tactical calls for next 3-6 months. And beyond that, we'll try as the yield starts settling lower, we'll shift from GSEC to corporate bonds to take this advantage of spread expansion in next 6 months, and we try to optimize return in our actively managed portfolio. If someone who is looking to have a tactical trades to play for this bond indices inclusion, we are launching a new NFO in our index funds where we'll be buying the 10-year FAR securities, where we think that the maximum will play out for this bond indexes inclusion. As of today, the 10-year G-Secs are trading at closer to 715 to 720, but we do see in next 6-8 months this to settle closer to sub 7%, or at least closer to 675 to 7%, which means that there is about 25 to 30 basis point of duration play which will play out on a duration of 6 years. But $2 of gain which will be there in offering over next 3 to 6 months, and on top of it 7% of carry. So if someone wants to play pure bond indices inclusion, they should invest in these index funds. If someone wants to align with actively managed funds, which is what we do very actively as a fund house, then they should come into corporate bond funds, banking PSU funds, short-term funds, and dynamic bond funds as a category. And I do think that over next 12 months, tactically, fixed income is going to make returns very, very smartly, real yield terms, given that the inflation is settling at 4.5 to 5. My base case is that all these duration products, they are going to give you returns. If my view play out, or as a fund house our view play out, anywhere between 8 to 10%, depending on the kind of rally it plays out. But that's the kind of duration money is going to give to our investors if our view play out. So I'm not trying to give you that this is the return going to make, but if I look at the scenario analysis, I do think that the fixed income is going to make anywhere between 8 to 10% over the next 6 to 12 months horizon, and which is why investors should flock in and to take advantage of these duration play by this actively managed mutual funds. I'll pause here, Amit, and let's open up session for question and answer.
Sure, Kaustubh, thank you so much for being so crisp and being informative. There were so many bullet points, but I request all the participants to post your questions in the Q&A, or you guys can mail me, or you can forward those questions to your respective RMs, which I'm already getting in our internal chat box. Kaustubh, first question is accrual. I mean, already you have given answer, but still, accrual or duration for portfolio allocation at this moment of time?
Look, at this point of time, I will say any day duration will make a lot more sense, because nominal yields are too high, and as headwinds. So what was the headwinds for Indian nominal yields? So the first headwind was oil, or uncertainty because of geopolitics. At margin, that has settled. The second was some bit of a fear that government will enter into more kind of a fiscal profligacy because of upcoming elections. But it seems that because the uncertainty on political front has somewhat reduced, so government is in no need for that government doing that, which means that government will stick to its fiscal deficit path, which means that inflation won't become a problem, and RBI, it gives a space or headroom to RBI to remain accommodative. The third thing was largely coming from the global yield of global central bankers. That also at margin has to some extent has taken a backseat. So you look from a fundamental side, you look from a technical side, from a demand supply side, all checkbox are taking out that the yields can rally 25 to 50 basis point here. So unlike US, where yields were taken too high, right? In India, the yields are not too high. Yields are relatively measured. So US 10-year used to trade at closer to 2.5, and it went as high as 5% about a month back when we launched our US 10-year treasury fund, right? So US has a lot of space. So we do expect that unlike US, India doesn't have that space, because India 10-year long-term average is closer to 6.5 to 7, or rather 6.75, and we were trading at 7.25. Okay, so India don't have a space of 100 basis point of rate cuts or 100 basis point of rally, but India do have a space of 50-60 basis points, and which is why, and most of these gains will be front-ended rather than back-ended, which is why at least for next 3-6 months I'll advise investors to stick to duration part of it. And at some point of time in next 3-6 months, as these duration play starts accruing out, you can shift to accrual. Now someone can ask that why not shift accrual now only if ultimately at the end of 6 months we have to make that move? So look, India, given that India nominal growth is good and the deposit credit ratios, banks are struggling with incremental credit deposit ratios and the demand for money is growing, we don't see credit spreads shrinking much. Credit spreads actually have not widened. What has widened is liquidity spreads. The credit spreads will widen as the growth undercurrent becomes more pervasive. That's when the demand for money will go higher and higher, and that's when the spreads will widen from here. So our base case is that the spreads will widen over next 3-6 months. That's when I'll say that one should shift to accrual, which is why if you ask me which is the best duration funds to, because I can see one of the question there, and let me preempt that. So I do think that the best duration funds at this point of time may be kind of a dynamic bond funds, or you can say the index funds that we are coming out, which will have a very low expense, but they will have this far security access for bond indices inclusion, or income and yield fund for next 3-6 months. And then at some point of time, you need to move to credit or accruals, which is like corporate bond fund, short-term funds. But if someone doesn't want to do this active management, then they should come right away into corporate bond fund, banking funds and short-term funds, where we are going to do this for them.
Okay. Thanks, Kaustubh. Varinderji is asking, I mean, considering the taxation, can we buy now G6 directly?
Yeah. So look, it's unlike prior to March 2023, where taxation was a clear advantage to the mutual fund route. Now that is available to you directly as well. Only thing I would say is that compared to the direct investments, if you come to mutual funds, we do provide anytime liquidity. So you need not find out brokers or platforms, where our experience is that a lot more inefficiencies starts kicking in, because these secondary market platforms, they are a lot more illiquid, and unlike mutual fund platforms where you can just redeem all of your investments at one stroke. The second thing is that at margin, because it's not that we are handing year with a absolute very high rates, right? Markets have preempted some bit of easing because of this policy makers change in heart. The markets will remain volatile. So at margin, by doing this in out, we'll try to create some bit of positive alpha for investors, which unless you are very actively tracking market day in day out 24 hours, it's very difficult for investor to do it. That most likely will try to make it for you. The third thing is that we will very swiftly move, if you are coming in our actively funds, from GSEC to corporate bonds. My experience or my conversation with most of these direct investors is that they are not able to do it as fast, and which is why we can do it much better, at least I believe. And the data also suggests that if you compare it with traditional source of deposit, or if you compare with the roll down strategies, actively managed funds have done much better than passively managed funds. The last point to this question is, which is where I'm coming, is that we are coming out with a fund of actively managed or index fund, where we are going to hug the FAR Securities 10-year benchmark index at a very minimal expense, right? So the expense, if someone is sensitive to expense ratio, I think they can go and invest there. It's like direct investment only with a 15 to 20 basis point of expense proposition, or regular through distributors 15 to 30 basis points. So which is, I think, the basic difference between direct investing and investing through mutual funds. So these index funds, they give you similar platforms with the liquidity that a mutual fund provide with a lesser expense, and that's where they can invest it.
So thanks. Madhuji is asking, what will do better, Indian GSEC or US Treasury Fund?
So look, if you would have asked me this question a month back, that's when we come out with US FOF, then of course, hands down, I would say US GSEC would do better. We expected US GSEC to, and we do expect still, that it will trade closer to 3.5 in calendar year 2024. As of now, it's 391. So that's where we think that the fair value of GSEC is there. It can go lower, but that's where we'll first reassess our call on US 10-year treasuries. At this point of time, I would say the case is more evenly balanced between US and India. because India also provides higher nominal yields in the sense that Indian yields are at 7 and they are at 4. So there is a 3% carry benefit which happens if you invest in Indian govies. So now at this point of time, the case is evenly balanced. Given that the demand supply mismatches which are here, I'll at margin say we are more inclined towards Indian bonds, Indian 10-year bonds now compared to US 10-year bonds. But at the same time, I'm saying that I do still think that USTs are going at 3.5 centric in calendar year 2023. That's our base case scenarios. And if growth slows down substantially, then it can move even closer to 3. Right? But as of now, we are not in a recession camp. We are more in a soft landing camp. We are more in a, I would say, more of a status quo camp of what we have seen in 2023, which means that we do think that UST is trading closer to 3.5 and stabilizing at closer to 3.5. Which means that if India also we expect 25 to 50 basis points and US also we expect 25 to 50 basis points, then the case is even. But because India carries higher compared to US, you can say at margin, India is better than US now.
Sure, thanks. Can you explain duration funds in a layman language, just in 1 or 2 minutes? Yeah.
Look, there are 3 drivers in fixed income. One is liquidity, one is credit, one is duration. Now, what is duration is it's an absolute movement in yield curve up and down. So when I say that I'm buying 10-year GSEC, the duration of that GSEC is 6 years, which means that that every 1% move in interest rates will give you 6 rupees of gains. Okay, because we expect move in the range of 25 to 50 basis points, we are saying that on a 6-year duration into 0.25 to 0.50, the gain is closer to 1.5 to 3. The middle point is about 2 rupees of gain you will make if interest rates actually move by 25 to 50 basis points, right? Because there is a shift in yield curve lower, right? If 1 year also move by 50 basis points and 10-year also moves by 50 basis points, because of the duration, the incremental gain on 10-year will be significantly more than incremental gain in 1 year, because 1 year has a duration of 1 year, but 10-year has a duration of 6 years.
Right.
Okay. So if move plays out like this, what you will end up earning is 7% YTM, which is the carry on a 10-year GSEC, plus this capital gains of $2, right? Which means that the if actually yields move by 25 to 50 basis points, most likely at the end of 1 year, the holding period return, which means that you have hold the GSEC for 1 year, 10-year GSEC, what you end up getting is 7% carry or the YTM or the coupon, and you will end up earning 2 rupees of gain. So about 9% of returns you will end up earning if yields move between 25 to 50 basis points. So that's a duration gains, that's a capital gain that we are talking about, that the investor can flock in if they invest in GSEC at this point of time.
Sure. Thanks. Kamla Ganji is asking for US treasuries, which tenure, like 1 to 3 years, 3 to 7 years, or what 10 years would be considered to be a sweet spot?
I would say still 10-year is a sweet spot. What markets are pricing in as of now is 6 rate cuts now. Okay, and which in our view is like a reasonable best case scenario. The base case scenario should be more like 4 rate cuts. Markets are pricing 6. The base case, our base case is more like 4 rate cuts. The market is pricing 6, which means that short end is fully pricing out rate cuts. So we don't see much of a space at a shorter end from this level to hold on. On the belly of the curve, which is 10-year of the curve, which is usually the most liquid curve, if growth actually slips faster, then that will start pricing in the rate cuts will remain lower now, or will mean revert to what it was prior to COVID at margin, which is 2.5 to 3. On the longer end side of it, this is beyond 10 years, which is 15 and 20 years. It also makes sense compared to 2-year point, but it does have a headwinds of very high fiscal deficit that the US is running, which is why we do think that 1 year down the line, if US continues to run this kind of fiscal deficit, we will see some bit of a steepness in the curve, but most of this steepness will play out in 10 to 20-year point rather than 2 to 10-year point, which is why I do think that 10-year is a sweet spot in US.
Sure. You spoke about the base case. What's the most probable downside risk you see over the next 12 months?
Downside risk on growth or inflation?
Both.
Okay. In US or India?
India.
So our base case is inflation, of course, is 475, because it is driven by the view of core inflation of 4 to 4 quarter and food inflation closer to 5%, which is where the combo is 4.5 to 475. If food inflation, which means that if next year the rainfall remains normal, okay, then food inflation can also settle closer to 4.5, and in that case inflation can settle closer to 4 quarter rather than 4.5 to 475. And in that case, our view, which is that RBI will cut rates somewhere in Q4 24 or 225, I think RBI can preempt that and they can start cutting rates in Q2 2024 only. Okay. Or you can say another way to looking at this, that the base case is 6 quarters, so 6.5 growth. If for any XYZ reasons, some because of political uncertainty starts evolving, or if the global slowdown is significantly more and that takes India growth lesser than 6%, then also RBI can cut rates, because RBI do have lot of space. I'll not say lot of space, but do have a 50 basis point of space to cut rates without impacting inflation matrices. Because you're talking about base case and best case, let me also take you to the worst case scenario. Now, the worst case scenario is that if global growth, because Fed is doing an attempt to achieve the slow, soft landing, and if global inflation relapses, because markets start thinking that the growth is not slowing down, and that takes the inflation higher, specifically through commodities, then the core inflation, which our base case is more like 4 quarter, it shoots to 5%. And if next year also the rainfall is little erratic, and like this year when the food inflation as of now is running closer to 7.5%, it moves closer to 7%, and that takes inflation at prices instead of 4.5 to 475 to more like 5.5, then RBI will not cut rates, or rate cuts will be absolutely ruled out. Okay. Now, in that scenario, in my view, of course, duration will backfire and will start hugging closer to 7.5 instead of 675 as a base case scenario. Now, in terms of probability distribution, because we are talking about base case, worst case, and best case, I'll say 50% chance that we stick to our base case, which means growth inflation in India remains Goldilocks and will settle closer to 675. About 30% chance that the best case plays out, which is inflation settle closer to 4 quarter, growth remains reasonable, or growth also slows at margin, which means that we will trade at 6.5 on 10-year GSEC. And the worst case, I'll say 20% probability, preliminary driven by global commodity pullback, and which means that the global relapse of inflation, which means that global central bankers, which are at margin breathing easy, they start unwinding these rate cuts which are being priced in, and in that scenario we will see GSEC inching back closer to 7.5. So that's how my distribution is played out.
So the next one is, I'm about to get a lump sum from PF, about 1 crore. How should I allocate this across debt mutual funds?
So look, because in the absence of other details like age and other requirements, I would advise that 30% of your portfolio should remain in liquid plus to take care of your day-to-day needs, because these funds, they don't run very large duration. Duration is usually 6 months to 1 year. You don't expose yourself to very large market markets. So in that scenario, the objective should be at least 1/3 money should give you stable accruals, which is where these liquid plus comes in. About 50% I'll invest in corporate bond funds or banking PSU funds of the world, which invest in AAA corporate bonds and mix of GSEC. They run duration closer to 3 to take advantage of a little bit of carry, but you can expect anywhere between 7.5 to 8% kind of accrual returns over long period of time frame. And because there is a duration play which is on the horizon, I'll say 20% of money I'll pay for duration by investing in these index funds.
Sure. Mr. Aditya is asking at what point we need to shift from the low duration to long duration debt funds, and which are the funds you are recommending for the long term?
So it's more or less the same. The time is now. The time is not something in future, because look what has happened is the Indian yields have rallied from 735 to just 715, 20 basis point of move, and we expect another 40 basis point of move. And as data plays out, it seems that most of these duration gains will be front-ended rather than back-ended, right? So if you're taking willing to take a duration risk, I think the time is now. The best fund, in my view, it remains the same. The index funds, which invest in these far securities. If you want to be technical, if you are not a technical investors and you want to leave it on us or on our capabilities, then corporate bond funds, short-term funds, and dynamic bond funds, depending on your risk appetite.
Sure. Mr. Sham is asking, why is there a recent rally in the GSEC, and also there is some issuance of 3 months CPCD in very attractive rate than accrual in good short-term period?
Yeah, because look, all these short end hugs very tightly with what's happening on the liquidity front, which is very tight in India as of now, which is why short end yields are at 7.5 to 8% across the board, AAA yields. Okay, GSEC yields, because market job is to preempt policymakers, and markets are preempting that even RBI will turn dovish, because the variety of headwinds that we spoke about in last 45 minutes, they are turning in favor of India, which means that RBI can now breathe easy, which means that they can at least the probability of duration loss is lot negligible now than what it used to be about a month back, 2 months back, 3 months back. So markets are preempting that even RBI will cut rates at some point in 2024. Markets are preempting that RBI will turn instead of or stance or changes in stance from withdrawal of accommodation to a neutral at margin. And at margin, markets are citing that in 2024 there will be a demand supply mismatch which will evolve on dated GSEC securities, which is why most of the rally that we have seen in last 1 week, it is happening on GSEC rather than corporate bonds. So all these reasons are the reason why GSEC is rallying, but short end is not rallying.
Sure. Mr. Deepak is asking if any investors plan to create a debt fund portfolio with a combination of various duration debt funds, short term, medium term, and long term. What is the percentage allocation you would suggest? Kindly also explain your rationale increase.
Look, first of all, Deepak, it depends on your risk appetite and your money needs in your aging profile. So I'm not aware of it, but absence of it, let me take, I'm a 40-year-old guy, and let me take that's as a median age of our investors. If that is the case, I'll invest 1/3 in low duration and money markets and ultra short term fund, and I invest closer to 50-60% in corporate bond funds of the world, and 15-20% I'll invest in tactical duration calls. Now, when I'm very bullish on rates, I'll move 1/3 of money which is lying in ultra short term or money manager or money market or low duration. Half of money I'll move to I'll say duration products like index funds, gilt funds. When I'm neutral on rates, I'll shift back allocation back to these. So the core portfolio, which is 50-60% of the portfolio, has to be invested in corporate bond funds or short-term funds, because they are all kind of all season funds. They get benefit of both duration and accrual at margin, because they play 50% of both. Remaining 50%, I am investing it depending on my view on interest rates. If I'm bullish on interest rates, I'll go overboard on duration. If I'm neutral on interest rates, I'll split between them and ultra short term category equally. If I'm negative, I'll go overboard on you can say ultra short term fund as a category. So what's your view on interest rates? What's your risk appetite? What's your financing needs? What's your money needs? Depending on that, you need to have your asset allocation funds. But 50-60% has to be in this short-term fund as a category, because that category will give you advantage, or we will play for you that advantage of active interplay of duration, liquidity, and credit from time to time.
Sure. Would there be a delay in the rate cuts in India compared to when it happens in USA? And what is the difference historically?
Look, of course, there will be delay because India growth is not slowing, US is slowing. US rates are too high from their historical perspective. India rates are not high. We are just 50 basis away from long-term average. US is about 200 basis away, or 300 basis away from their long-term average of last 20 years. So of course, not only US will cut rate prior to India, they will cut significantly more than India. So that's your first part. Historically, what is the difference? So look, the difference is driven by what's the growth inflation dynamic. Okay, when I'm saying growth, and especially the real yield dynamic. So India inflation used to trade consistently as closer to 6.5, and India repo rate was at closer to 7%. If you compare it prior to 2013, post 2013, India average inflation is 5, and India average repo rate is closer to 5.5. Okay, which means, and post 2013, or rather post COVID, US average inflation is 6 and India average inflation is 5.5, which means that US has to keep significantly more higher rates compared to in India, but they have not done it because they are developed world. So looking at yield differential is not a right matrices. What you should look at is the real yield differential. As we speak, US real yields are at 2, India real yields are you can say closer to 2.5. So what you should track is that India will give you about 50 to 75 basis point higher real yield compared to US. That should be the yardstick, and that's how you should track it. That being emerging market world, we need to give you investors little more higher real yield compared to what US is given. Then the money flow in India will remain continuous. If US cut rates, assuming at closer to 3.5, which is what markets are pricing in over next 12 to 18 months, I think India will have a space to take rates down closer to 5.5, ceteris paribus. What is the ceteris paribus? That India growth is closer to 6 quarter and inflation is closer to 5. But if India growth is 7, then probably India needs to take rates higher, because then that risk that higher growth can turn into inflation.
Okay.
Which is why there is no single yardstick. Depending on evolving growth inflation dynamic, depending on global real yield, depending on our financial stability conditions, we need to be a lot more agile compared to developed world. But the base case is India will take rates closer to 6% somewhere in 2024 and or 2025.
Sure.
But just that makes just 50 basis point, unlike of US where our base case is 200 basis point over next 18 months.
Oh, so would this rate cut have dual effect positively? I mean, definitely, I mean, it will reflect in the equity markets as well.
Look, the purpose of rate cut is to support growth. Okay, and if you look at asset allocation wise, ideally bond and equity market movement should contra. If equity market is moving, ideally bond market should not rally, and if equity markets are dooming, then bond market should rally, citing rate cuts, right? So this is theoretical framework, because India is in a Goldilocks scenario, which is like good growth and good inflation, or which means that 6.5 growth and 4.5 kind of inflation. Yes, both assets can rally together. We do think that we are in that scenario as of now. Okay, and which means that both equities and bonds yields can rally as of now. But you should not confuse it that all point of time this happens. Usually they move in contra terms.
Sure. So what's your view on the HDL funds or how debt index funds you look at? Rather it's active or passive?
Look, SGL funds, they generally move in tandem with what happening on the dated securities, because dated securities has this new potential buyer in the form of bond indices inclusion. I'll be lot more positive on dated central government securities compared to state government securities, which is our base case is that the spread between central government securities and state government securities, it will widen over a period of time. It is already elevated. If you see last 3 months, it has widened from 25 basis points to now 45 basis points. Our base case is that it settled closer to 60 basis points.
Okay. View on the long duration funds has been covered. So Joshi sir, your question has been answered in the initially. Varinder ji asking whether debt index funds are better than debt ETFs.
There are not many debt ETFs in the market.
Yeah.
Because operationally it is difficult to manage, and which is why AMCs, and specifically we prefer debt index funds instead of ETFs. Okay. Barring that, there is not much of a difference between debt index fund and debt ETFs. If you are coming and looking for debt index funds, you have variety of option bouquets. For example, in our fund house, we are already giving you 4 index funds. 3 index funds are already in play. 4th index fund is coming up to play this FAR securities on 10 years. So as we speak, we have 4-year, 5-year, 6-year index funds, which will invest in 4-year, 5-year, 6-year FAR securities, which bond indices guys are going to come in. Now we are coming out with 10-year index funds, which will invest in this FAR securities. So you have so many bouquet, depending on your risk appetite, depending on your view, which point of the curve you want to invest in. You can pick and choose that duration index fund to invest in, or in a particular FAR security index fund to play out this bond indices inclusion. That kind of flexibility is not there in ETFs, which is why ETFs are relatively illiquid. The third thing is that in ETF, because at least retail investors, they generally root through market makers, which do quote bid and offers. They are relatively inefficient compared to index fund, not material but relatively inefficient, and which is why, unlike equity where markets are deeper, unlike equity where the tracking error is very limited, unlike equity where the availability of bouquet options in ETFs are significantly more in numbers, in debt funds, I'll prefer index funds rather ETF.
Okay. Should one exit credit risk funds as yield on other funds are compatible to credit risk without the risk?
Look, like all cycles, as I told you that there are 3 areas: liquidity, duration, and credit. That's where the alpha of fixed income is made. Like all cycles, credit also has cycle, right? We do think that post-COVID, the credit spread collapsed. They collapsed for 2 reasons. Because capital markets were out of credit funds. None of the credit funds, or rather all credit funds, they saw large outflows post-COVID. And even in last 18 months, none of the credit funds have been able to garner any tractions. So the credit spreads were too low. Second, because banking balance sheet and corporate balance sheets were very good shape, the borrowers were not giving reasonable spreads. The third thing is that because of the abundant liquidity, the spreads collapsed and the banks start chasing in their loan book these credit papers rather than them coming to the corporate bond market. Now, some of these headwinds, they are changing in the sense that liquidity is now tighter, credit is now picking up. We are sitting at the cusp of some capex cycle, which means the demand for money will go up, which means that at margin the spreads are widening. As we speak, in last 3 months, spreads have widened and they will continue to widen over next 3, 6, 9, 12 months. If India growth stories remain where it is now. Now, in that scenario, when you're looking at absolute YTMs, yes, the observation is true that today, adjusted for expense, the YTMs or the net YTMs are not much. But in next 6 to 12 months, I do expect these YTMs to start giving you reasonable proposition. So at some point of time over next 3-6 months, I will be strong proponent of credit funds. So we are already starting warming up to this idea, and I'll request you, or rather suggest you, is that you also start warming up the idea and start citing any credit fund or credit gross YTM you're finding it closer to 9.5 to 10. I think is a reasonable proposition. In my view, at least the credit risk as of now on Indian corporates, it's too low. I'll not say it's negligible, but it's too low. So these are free spreads or kind of a good spreads which are available. But because they charge higher expense, the cutoff rate is closer to 9.5 YTMs. So if you are getting YTMs more than 9.5, start investing.
Thanks. And this is the last one. Mr. Sunil is asking, how much would exchange rate play affect your assumption of real yield being more in India marginally than US?
Look, exchange rate is, if you look theoretically by the logic of interest rate parity, currency movement is a reflection of growth and real yield differential, which means that if the real yield is reasonable, which is what I am saying, that India need to give some bit of higher yield compared to US, the pressure on Indian currency is very, very limited. And as a matter of fact, India growth is better than US. So both the thing will ensure that India exchange remains stable. Our base case is that dollar is peak. Our base case is that, of course, RBI will remain little asymmetric, that they will not allow rupee to appreciate, but they are comfortable with some measured depreciation in rupee to ensure we have competitiveness in terms of export pricing. And given that our current account deficit remains in this range of 1.5 or 2, which is manageable, and our BOP is going to remain surplus in 2024 and 25, because of this bond indices inclusion, and also because if political certainty is established in May elections, we are expecting large FDI inflows will start moving back, and especially in the backdrop when global yields are peaking out, I think exchange rate movement importance have subsided quite dramatically. Other way to look at this is that exchange rate becomes a variable only when your financial stability is in question. Your financial stability is in question when your current account deficit is in a problem or your BOP is in large deficit. We don't see either of scenario as of now, which is why I'll say that I'll not say it's not negligible, but it's a very, very small probability that it's a problem for policy setting and interest rate movements.
So thank you so much, Kaustubh, for explaining all these questions in detail, being so crisp. Thank you so much, audience, our friends, being joining on this Saturday morning. And sure, I think we will catch up with such kind of sessions on monthly basis with you. My takeaway of around this call is, of course, asset allocation plays a very vital role, but I think this is one of the point where investors should consider about the duration funds. This is exactly sweet spot. So please talk to your respective RMs, and I'm sure they will advise you on this. So once again, thanks, Kaustubh, and thanking everyone.
Thank you. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। स्कीम संबंधी सभी दस्तावेजों को ध्यान से पढ़ें।